An avalanche crisis triggered by Silicon Valley Bank and then triggering the banking industry in the United States and Europe is coming fast. In addition to the high inflation in the United States and Europe that triggered frequent interest rate hikes by the Federal Reserve and the European Central Bank, the U.S. banking crisis has even spread to the European continent. In early May, the First Republic Bank of the United States was also shut down due to a broken capital chain, becoming the third U.S. regional bank to be shut down in 2 months. In Europe, a report from the British Daily Mail on the 5th also confirmed the serious impact of 186 banks in the United States will face the risk of bankruptcy, stated by the USA Today. This may mean that since the collapse of Silicon Valley Bank in the United States and the thunderstorm of Credit Suisse, people in Europe and the United States have begun to change their minds and are less willing to deposit money in banks. They may suffer from high inflation while also suffering from the local banking industry. Harvest. In response to global inflation and declining market demand, e-commerce giants Shopify and Meesho in North America and South Asia have taken turns to lay off employees. We have made the difficult decision to lay off 251 Meesho employees, or 15% of our workforce, as we look to build a leaner organization to achieve sustainable profitability. On Friday, May 5, local time in India, Meesho, India's #1 social e-commerce giant, announced a new round of layoffs of 251 employees. According to Direct Cross-Border Understanding, Meesho, as a social networking platform established in 2015, has launched 2 rounds of layoffs after the outbreak of the epidemic. In addition to this layoff, one is that the company laid off more than 200 of its more than 700 employees 3 years ago during the first wave of the COVID-19 pandemic. The second is that in April 2022, the Indian social commerce platform Meesho was exposed to layoffs of more than 150 people, mainly from its grocery department superstore, Meesho. In contrast, Shopify, the largest one-stop SaaS e-commerce service platform in Canada, announced in an internal memo in July 2022 that the company will lay off 1,000 employees, accounting for 10% of the total global workforce. Of course, this is also the first large-scale layoff of Shopify since its inception. The main reason for Shopify's layoffs last time was that business growth was not as strong as expected due to the double impact of the epidemic and high inflation in Europe and the United States. This time, Shopify CEO Toby Lutke announced on the official website that it will sell its logistics business and lay off 20% of its staff. Not surprisingly, it is also to reduce costs and increase efficiency under the global consumption crisis. According to the important team and business changes released by CEO Toby Lutke on Shopify's official website, its logistics business Shopify Logistics will be sold to Flexport, and the company will lay off 20% of its staff. For the frequent interest rate hikes in Europe and the United States, even e-commerce platforms around the world have taken turns to lay off employees. Which products will open up new possibilities in 2023? Which products should not be invested in 2023? According to relevant data agencies, based on past trends and current economic conditions, the following are some trade product areas that are likely to receive attention in 2023. 1. Technology products. With the development of technologies such as artificial intelligence, Internet of Things, cloud computing and 5G, related products, such as smartphones, smart home devices, driverless technology, etc., are expected to continue to maintain high demand. 2. Renewable energy equipment. Solar panels, wind power equipment and other renewable energy technologies are likely to be hot traded products due to the increased global demand for sustainable energy. 3. Electric vehicles and battery technology. With the increasing awareness of environmental protection and the decline in demand for traditional fuel vehicles, electric vehicles and battery technology are expected to become hot trade products in 2023. 4. High-end consumer goods. High-quality luxury and high-end consumer goods are likely to continue to attract the attention of the international market, especially for products targeting affluent consumer groups. 5. Medical equipment and healthcare products. With the aging of the global population and increasing health concerns, medical equipment, healthcare products, and medical technology are expected to become hot areas in the trade market. Here are some product areas that may see weakening demand and are not suitable for investment in 2023. These forecasts are based on current trends and market observations. 1. Traditional fuel vehicles. Due to the increasing awareness of environmental protection and the increasing demand for sustainable transportation, the demand for traditional fuel vehicles may gradually weaken. The popularity of clean energy vehicles such as electric vehicles may have an impact on the traditional fuel vehicle market. 2. Coal and fossil fuels. Global demand for renewable energy has increased, along with government and business commitments to reduce carbon emissions. This could lead to less demand for coal and fossil fuels, so this area may not be a good place to invest. 3. Traditional retail industry. With the rise of e-commerce and the popularity of online shopping, traditional retail industry may face challenges. Competitive pressure on traditional brick-and-mortar stores is likely to increase as consumers increasingly shop online. 4. Beverages and food in certain mature markets. The beverage and food industry in certain mature markets may face market saturation and intensified competition. Emerging markets and innovative products may be more attractive. For the frequent interest rate hikes in Europe and the United States, and even the layoffs of e-commerce platforms around the world, do you think it will affect your overseas revenue? Welcome to leave us a message in the comment area.